Imagine a promising startup, great idea, really poised for greatness, but they're looking at maybe a 2-year slog of paperwork and roadshows just to go public.
Yeah.
What if there was a secret passage, a sort of backdoor entry to the stock market? Today, we're pulling back the curtain on that exact thing. It's called reverse takeover.
Mm-hmm.
Our mission really in this deep dive is to unpack what an RTO actually is. Why would a company choose this less conventional route over a traditional IPO? And we want to uncover the benefits, which can be surprising, but also the drawbacks, which people often overlook.
Absolutely. And we're going to try and distill the key insights from the sources we've looked at to give you a really comprehensive, nuanced understanding of this. It's quite a complex financial maneuver.
Yeah.
It's about seeing past those initial ideas and really getting the full picture.
Okay, so a reverse takeover. The name itself, it sounds like the opposite of what you'd expect a takeover to be, right? What exactly are we talking about? How does that reverse part work?
Yeah, it's a great question, and the name definitely gives you a clue. Basically, an RTO involves a smaller company, one that's already publicly traded, taking over a larger private company.
A smaller one taking over a larger one.
Exactly. And it happens through a share-for-share exchange. Now, because that private company is usually much bigger, a really substantial number of shares in the smaller quoted company get issued to the private company's shareholders.
So the original owners of the private company end up holding most of the shares.
Precisely. They end up holding the majority of shares, and this is key, they gain control of the now listed company.
So if I'm getting this right, the company that wasn't quoted is using this whole thing as a clever way to get its shares traded publicly, almost like a bypass. Is that the main idea?
That's exactly it. The core purpose is that the previously unquoted company has effectively achieved a listing on the stock exchange. It's a legitimate route, just unconventional. A good example in the UK was Stobart, the haulage firm. They got their listing back in 2007 by combining with Westbury, which was a property and logistics company already listed.
Interesting example. And I think I've heard it called something else in the US, reverse merger.
That's right, yeah. In the U.S., reverse merger is the common term. And it's also worth noting, an RTO can involve a quoted company that's actively trading, has ongoing operations, or it could just be a shell company not really doing anything, just a listed vehicle waiting for this kind of deal.
Okay, now you hear RTOs sometimes get, slapped with the label, the poor man's initial public offering. So you might be wondering, why would something that sounds like a smart shortcut get that kind of negative rep?
That's a really important point, and this is where our sources give us some critical context. Historically, particularly U.S. studies, they have shown that companies listing via a reverse merger generally had lower survival rates. Yeah, and they tended to underperform compared to companies that went through a traditional IPO.
Yeah.
So that perception, it definitely has roots in those earlier findings.
But hold on, poor man's IPO sounds pretty final.
Yeah.
Is that really the whole story? Has that held true everywhere, or is there more nuance to it? My gut says there's a twist.
You're absolutely right to push on that, because this is where it gets really interesting and it kind of challenges that whole perception.
Okay.
There's contrasting evidence from the UK. Studies looking at the period from, say, 1995 to 2012, they actually indicate that RTOs in the UK seem to have survival rates pretty similar to IPOs.
Similar? That's quite different from the US findings.
It is. And what's more, the best results from RTOs seem to happen when they involve a quoted company that's already actively trading, because then you can get synergy gains, right?
Right. Makes sense.
And interestingly, small RTOs tend to perform better than the larger ones. So no, it's definitely not a blanket underperformer everywhere.
That's a really important distinction. So, okay, if they're not always the poor man's IPO, why would a company choose this path, this less traditional, maybe slightly controversial route? What's the actual appeal over the standard IPO?
Well, first off, you have to remember that RTOs still deliver all the general benefits you get from any stock exchange listing.
Like easier access to money.
Exactly. Easier access to capital markets, potentially more finance available, maybe at a lower cost. Plus, listed shares often lead to a higher company valuation. Investors see them as less risky because of, regulatory compliance, and they're more liquid.
Okay.
A listed company can also do more takeovers itself using share-for-share exchanges. And it's easier to set up share-based incentive plans, which are really key for attracting and keeping top employees.
Right. So all the standard good stuff about being public is still there. But you mentioned specific advantages over an IPO. Is that where we really dig into why they picked the RTO route?
Precisely. And This is where it gets fascinating. The unique benefits RTOs offer compared to IPOs. First, speed. That's a big one.
Speed. How much faster are we talking?
RTOs can potentially be completed in as little as 30 days, maybe a bit longer, but compare that to an IPO, which can easily take 1 to 2 years.
30 days versus potentially 2 years. That's a massive difference. Wow. I guess that speed means managers can actually, manage the business instead of being bogged down in the listing process forever.
Absolutely. And they're less exposed if the market suddenly turns sour during that long IPO process. Think about it. In a place like China, the IPO process is famously slow, huge queues, and RTO lets a company effectively jump that queue.
That's a huge incentive right there. What else? Cost.
Then there's cost. Now, it's not always guaranteed, but RTOs will usually cost less than an IPO. An IPO involves significant work, huge fees for investment banks, sponsors, accountants. It adds up. And another really crucial factor, availability and resilience when markets are down.
Resilience, how so?
Well, the transaction volume for RTOs holds up much better in market downturns. For example, after the dot-com bubble burst, the number of RTOs actually increased, while IPOs basically fell off a cliff.
Increased, while IPOs dropped. That's surprising.
Yeah, and similarly, after the more recent financial crisis, the fall in RTOs was much less severe than the fall in IPOs.
Why is that? Why are they tougher when the market gets shaky?
It seems to be because RTO deals are fundamentally between shareholders of the two companies. So broad market sentiment has less of a direct impact on getting the core deal done. Plus, RTOs usually raise less new finance compared to IPOs, which makes them, maybe more palatable to investors in a downturn when capital is tight.
Okay, that makes sense.
That makes sense.
Just one more key thing. Existing analyst coverage. The listed company being targeted for the RTO probably already has analysts covering it. That coverage often continues after the RTO, providing immediate investor awareness.
Right, whereas a new IPO, especially a smaller one, might struggle to get noticed by analysts.
Exactly. It can be tough to get that initial coverage, making it harder to attract investors right out of the gate. So, it's a potentially powerful alternative. Speed, cost savings, resilience in tough markets. Sounds pretty appealing on paper. But, as we always say, shortcuts often have hidden tolls, right?
They usually do.
It sounds almost like the ultimate cheat code for going public, but, every shortcut seems to come with its own unmarked detours, maybe some hidden speed traps. And with RTOs, I get the sense those traps could be quite nasty. What are the big drawbacks the sources point to?
Yeah, this brings up a really important question, and you're spot on. RTOs definitely have a number of potential drawbacks compared to an IPO. Any company thinking about this needs to go in with their eyes wide open.
So what's hurdle number one they might hit?
First, there's a real risk of a lack of internal expertise. Think about it. A company listing via RTO might just not have the internal know-how, the people, the systems to comply with all the complex rules for listed companies.
Because the long IPO process kind of forces you to learn that stuff?
Exactly. That long IPO process, despite the pain, it actually serves as a valuable kind of regulatory boot camp. It forces you to get your house in order. With an RTO, you're jumping straight into the deep end without necessarily having had that same training.
So they really need to hire people who know this stuff.
Absolutely. They must consider hiring or retaining staff with compliance expertise right from day one, or they could get into trouble fast.
Okay. And what about that reputation issue you mentioned earlier, the poor man's IPO tag? Does that still hang around?
It certainly can, yeah. Those reputation concerns persist, partly because of past problems. Back in 2011 and 2012, there were those accounting scandals involving over 100 Chinese firms that got onto U.S. markets using RTOs.
100 companies. Wow.
Yeah, it led to suspensions, delistings. It was a big mess. It gave RTOs a bit of a black eye. The SEC, the U.S. regulator, even put out a public warning back in June 2011. They told investors that many companies either fail or struggle to remain viable, and pointed to instances of fraud and other abuses involving reverse merger companies.
Ouch. Have things improved since then?
Oh, yes, definitely. Regulations and standards for RTOs have been tightened up globally since then to try and prevent similar issues. But still, that historical shadow can linger, and it might impact how some investors view an RTO company.
So maybe higher risk perception for investors then, given that history.
Exactly. Because there's generally a lower level of scrutiny compared to a full IPO, investors should be aware of potentially higher risks. And it works both ways. The unquoted company really needs to do its homework on the listed company it's acquiring to uncover any hidden problems or liabilities. It's definitely buyer beware for everyone involved.
Okay. You mentioned speed as a benefit earlier, but are there still big regulatory hurdles despite potentially being faster?
Oh, absolutely. Yes, it can be faster overall, but RTOs still involve significant regulatory hurdles. They're complex deals, sort of a mix between an acquisition and an IPO.
For example?
Well, in the UK, the FCA's standard approach is that trading in the listed company's shares will often be suspended as soon as an RTO is announced, or even just leaks out.
Suspended what?
Because there usually isn't enough public information available about the unquoted company for the market to trade fairly. Now, you can try to argue against suspension, but it takes a lot of work, and if a suspension happens, the listed company might just walk away from the deal.
Okay, that's the big one. Yeah. Any others? Another potential hurdle is something called the mandatory offer rule. This rule is there to protect minority shareholders. It basically says if a shareholder from the unquoted company, or maybe a group acting together, ends up holding 30% or more of the listed company's voting rights after the deal,
30%, okay.
then they usually have to make a cash offer to buy out all the remaining shares.
Wait, so they'd have to buy the whole company? That kind of defeats the purpose of just getting listed, doesn't it?
Completely. It undermines the whole point. Now, waivers can often be granted under specific conditions, but it's a major regulatory point you have to navigate carefully.
Right, definitely sounds like it could throw a wrench in the works. What about the share price? After the deal is done, does it hold up? That's another risk area. Share price, decrease risk. You see, many of the listed companies targeted for RTOs, well, they might have had problems in the past. That's often why they're targets.
Okay.
So their existing shareholders might just be waiting for the deal to complete so they can dump their shares and get out.
So an overhang of sellers.
Exactly. To try and stop this, you might see lockup periods imposed. That means certain shareholders have to promise they won't sell their shares for a set amount of time after the deal closes.
Okay. And finally, cost. You said RTOs are generally cheaper. But is that always true? Are there hidden or unexpected costs?
That's a really crucial point. Yes, while generally cheaper on paper than IPOs, RTOs involve significant direct and indirect costs that can easily blow past expectations.
Like what?
Well, there are the regulatory costs, navigating all those hurdles we just talked about. That takes time and money. Then there's the acquisition cost itself. The listed company target might demand a pretty big premium, especially in markets where RTOs are seen as an easy option.
Right. I remember reading the sources about some really unusual combinations. Does that pressure to find any target drive up costs or create weird deals?
It absolutely does. The pressure to find a suitable shell or listed company can lead to some, frankly, bizarre situations. Our sources mentioned cases like a cutting-edge mobile game developer desperate to get listed.
Yeah, who did they merge with?
They ended up acquiring a shoe company.
A shoe company, seriously.
Seriously, you can just imagine the synergy meetings, can't you? So how do we integrate non-fungible tokens into our new line of loafers? It just highlights how desperate companies can get. And think about the hidden indirect costs of trying to smash together two totally unrelated businesses, culturally, operationally. It's not just about the deal price.
Wow. Quite a combination.
And there's more. Even after the RTO is done, to actually generate proper liquidity, get real investor interest, you often need a comprehensive investor relations and marketing program. That's another significant indirect cost that maybe wasn't fully budgeted for.
So the real insight here isn't just that RTOs are a shortcut, but maybe they come with their own unique set of hidden tolls. Not just financial, but reputational, operational. Almost like a convenience fee for skipping the long IPO road.
That's a great way to put it.
You're trading one set of challenges for another, and maybe sometimes those new RTO-specific challenges are even trickier to navigate.
That sums it up perfectly, I think. It really becomes clear when you look at it closely that there's genuinely no easy button to press for a stock market listing. The complexities just change shape, demanding a different kind of planning, a different kind of risk assessment.
So given everything we've uncovered today, the benefits, sure, but also the hidden hurdles, the reputational baggage, the sometimes surprising realities of these reverse takeovers. The next time you hear about a company going public via an RTO, what new questions will you ask yourself about their strategy, about their potential path forward? We hope this deep dive helps you look a little closer next time and maybe even reevaluate what shortcut truly means in the world of finance.